Hello everyone. Today we're going to look at life insurance. So for life insurance, we're going to look at three different situations. The first one is purchasing life insurance. The second is non-forfeiture options, which means what can I do if I want to stop paying for my life insurance? And the third is settlement options, or I'm a beneficiary of someone else's life insurance who's passed away. What are my options? So we've got three things that we're going to look at. The first one is purchasing. So we have three tables in this section, and this is the first one. So a couple of things to note. It is annual, so it's for a whole year. It is per $1,000. So remember, per $1,000 of face value means I'm going to take the number from the table, divide it by 1,000, multiply by the face value. And for this table, it's also important to note that these ages have to do with male applicants. Females and males have different life expectancies. So if I have a woman, in order to use this table, I'm going to subtract 5 years from her age. So if I have a 40-year-old woman, I'm going to look at 35 for the male table. If it's a male and he's 35, I look at 35. Right, but again, if it's a woman, we need to subtract 5 from her age and look at that number on the table. We also have three different types of insurance here. The first one is term 10-year. So what that means is that you buy it, you have 10 years of payments, and you are insured for those 10 years. As soon as those 10 years are up, you no longer pay. You're also no longer covered. So if you pass away the day after your 10-year term ends, your beneficiaries get nothing. This is always the cheapest option, and usually when you see commercials for life insurance, they tell you they're great rates. They're for 10-year term life insurance. The next one is whole life. So as that implies, you both pay for your whole life and you are covered for your whole life. So assuming you keep paying, you're going to be covered until you pass away. The third option is kind of a mix between the two. So it's called limited payment, and then there are a different number of year options. The one that we're going to pay attention to is 20 years. It's probably the most common. So the limited payment means you pay for those 20 years. However, you are covered until the day you die. So even if you die 45 years after you first buy it, you pay for the first 20 years. The next 25 years, you're no longer paying for it, but you're still covered. Okay, so those are the main differences between the three types. So let's look at an example of someone trying to purchase it. So a 30-year-old man wants $50,000 in life insurance. Find his annual premium if he gets A, whole life, and B, 10-year term. So if you haven't already, please pull up the tables. Again, I can't really go back and forth between the table and the screen, so I'm going to assume that you're also looking at the table. So a 30-year-old man, it is a man, so I'm going to look directly at 30 years. And for part A, whole life, I'm going to move over to the whole life column and look at the number that I get. So I should be getting 19.73 from the table. And again, it's per 1,000 of face value. So I divide it by 1,000, I multiply it by the face value, which is 50,000. And I get out $986.50. So that would be the cost for the entire year. Usually you pay it monthly, but that would be for the whole year. For B, we're looking at the same row, still 30 years, but now we're looking at the 10-year term column. And we should be seeing a $7.59. So again, this is the cheapest option. $7.59 is a lot cheaper than $19.73. But again, you're only covered for 10 years. So if we do out that math, we should be getting $379.50. Okay. What about a 30-year-old woman? She wants $75,000 in life insurance. Find her annual premium if she gets A, whole life, and B, limited payment 20-year. So again, a 30-year-old woman, in order to use the table, I need to subtract 5. So a 30-year-old woman is equivalent to a 25-year-old man. So if I look at the list for whole life under 25, I should be getting 17.22. Okay. So again, make sure you're looking at the table, make sure you can find the 17.22. Again, I'll divide by 1,000, multiply by the face value, which is now 75,000. And if I do that out, I should get 1,291.50. For limited payment, I'm just going to go to the next number on the column in the table, and it should be 28.06. So again, divide by 1,000, multiply by 75,000. The really nice thing about things that are per 1,000 is I can always cancel them. So what I'm really doing is just 28.06 times 75. Right? You can always simplify before you shove it into your calculator. And you should be getting $2,104.50. So the limited payment is always the most expensive, the term life is always the least expensive, and the whole life is always in the middle. Let's do another one. A 40-year-old man wants $30,000 in whole life insurance. Find his annual premium. So 40 years, man, I'm going to look directly at 40 years. Whole life insurance. From that table, I should be getting $28.26. Again, divide by 1,000, multiply by 30,000. Again, those thousands cancel, so it's just 28.26 times 30, and that's $847.80. What if he decides that he no longer wants to pay for his life insurance, say at age 55? What are his options? So it's not that you just lose all that money you put into it. You do have options. And that's going to be the second table that we're going to look at. So something to note, this table is going to be different depending on the age of the person who bought the insurance. So for the purposes of this one, we're going to assume that everyone bought their insurance at age 25. Okay, just so that we don't have to have, 20 million different tables. Also notice that it's still per $1,000 of face value. So in here it's divided between two types, whole life insurance and 20 payment life. The term, 10-year term life insurance does not apply here. If you stop paying for that, you're just no longer covered. Okay, so you can't have these non-forfeiture options if you have the term life insurance. So the first column, years in force, is just how long you've been paying. So if I bought it at age 25, if I'm now 30, it would be 5 years in force. So you gotta do a little bit of subtraction to figure out that. And then again, you gotta make sure that you know whether it's whole life or 20 payment life. And then in each of those, we have 3 categories. The first one is cash value. So that is the amount that I could just get a check for and part ways with my insurance company. I would no longer be insured. Okay. It's also the amount that you could borrow against, and if you want to still be insured, you have to still make your payments, and you have to be paying back the loan. Okay. The next one is paid up insurance. So this is kind of like taking your original policy and changing it into a payment life if it was a whole life, or into a shorter payment life if it was originally a 20 payment life. So the amount of money that you're going to get out of this, so when we take this number, divide by 1,000, multiply by the face value, that number is going to be what you could still be insured for the rest of your life. So even though you've stopped paying, you can still be insured until the day you die. It's going to be a lot less than your original policy's face value. Okay, but you would be covered for that amount up until you pass away. The last one, extended term, is changing your whole life or 20 payment life into a term life. So the extended term, this is not something that you would divide by 1,000 and multiply by the face value. Okay, it's not a dollar amount. It's going to tell you how many years and how many days that you are still covered for. So if I'm 25, I start paying for my life insurance. I stop at age 28 for some reason. It's 3 years in force. I am still covered for that whole face value amount for the next 1 year and 190 days. Okay. Notice after 20 years, there's really no reason to stop paying because it already is being stopped paying. So that's why these guys are life up here, and the paid up insurance is the whole amount. Over on the whole life, if I've paid for 40 years, I'm still covered for the rest of my life. Okay. So let's try some examples out. Assume the following people bought their life insurance policies at the age of 25 so that we can use that table. A 35-year-old man wants to stop paying for his $40,000 whole life insurance policy. Find his options. So again, he has three: cash value, paid up insurance, or extended term. So for cash value, we need to make sure that we're looking at whole life insurance and that he has been paying for it for 10 years. Okay, he's 35 now, he bought it at 25, so that's 10 years in force. And if we look at the table for cash value, we should be seeing 93. So we take the 93, divide it by 1,000, multiply it by 40,000. Again, that's equivalent to taking 93 and multiplying it by 40. And we get $3,720. So he could get a check for that amount and walk away, no longer be covered. Or he could still have insurance up until the day he dies, and we'll figure out how much insurance he'll have. So from the table, just the next number over is 248. And that will give us 9,920. So even though he stopped paying, he could still be covered for almost $10,000 for the rest of his life. The last option, extended term. How long will he still be covered for the full $40,000? So if we look at that for 10 years, 10 years in force, it is 18 years and 91 days. So if he has this feeling he's not going to hit another 19 years, then he could have this one and still be covered for the whole $40,000. So if you're going to stop paying, it really depends on how much longer you think you're going to live versus also how much money you want to leave your beneficiaries. Let's try another one. A 40-year-old woman wants to stop paying for her $100,000 limited payment 20-year life insurance policy. Find her options. So she has the same three options, but this time we have to make sure we're looking at the 20-year life insurance policy, not the whole life. So she is 40. If she's bought it at 25, that's 15 years in force. So make sure you're looking at the 15 years. Cash value of that should be 319. And again, we're going to divide by 1,000, multiply by 100,000. The thousands cancel, and we're left with 31,900. So she can get a check for $31,900 and no longer be covered. Paid up insurance, again, that's just the next number over, which is 768. So she could still be covered for the rest of her life, but only for $76,800 instead. Lastly, we'll see how long she could still be covered for the full $100,000 face value. And that's going to be 32 years, 164 days. And one more. A 65-year-old man wants to stop paying for his $50,000 whole life insurance policy. Find his options. So again, we're back to whole life insurance. And he is 65 years old. If he bought it when he was 25, that means it's been in force for 40 years. So we're going to be looking at that last line. And the cash value is 576. So 576 times 50 gives us 28,800. His paid up insurance, we should be getting 827 from the table. Multiply that by 50, and we get 41,350. So we could be covered for almost the whole amount, and that's because he's been paying it for 40 years. So he pretty much deserves it all at this point. the extended term, which would be the better option because it's for the rest of his life. So between these two, he could either be covered for the rest of his life for $41,000 or the rest of his life for the full $50,000. So really, if you bought your life insurance at 25 and you paid it for 40 years, there's really no incentive to keep paying because of this option right here. You're already going to be covered for the rest of your life. So now we're going to look at the third table. What happens if you're the beneficiary of someone else's life insurance policy? There are several options. It says here we've got options 1 and 2 and then 3 and 4. There really is a fifth option, which sometimes I call option 0, which is just one lump sum. So you can get a check, be on your way, and everything is fine. But that's not very fun mathematically. So we're going to assume that you want a type of monthly installment. So the settlement options are monthly. It's not annual. It's still per $1,000 of face value though. Okay? So options 1 and 2 are a fixed amount or a fixed number of years. So you can say, I want to get paid out over 12 years. And if you want to get paid out over 12 years, you're going to get $852 divided by 1,000 times the face value. And you're going to get a check for that amount every month. Or you could say, I want to get $200 a month. And then we do the math and figure out how many years you could have that for. Okay, so that's options 1 and 2, a fixed amount or a fixed number of years. Options 3 and 4 are called income for life or annuities. So an annuity is when you're getting the same amount every month, in this case. Remember, we've talked about it before. So options 3 and 4, right, these are really two different tables put together. You have age when annuity begins. We still have the same 5-year difference between a male and female. So this is the beneficiary, not the person who bought the life insurance. Okay. And then we have life annuity, life with 10 years certain, life with 20 years certain. So with a life annuity, you get paid that amount every month until you pass away. Life with so many years certain is you get paid that amount every month until you die. And then if you die before those number of years certain are over, so for example, let's look at this one. Let's say you choose this as your option and you get paid every month, but after 10 years, you pass away. So it says life was 20 years certain. So the insurance company knows that they're going to pay out this money for at least 20 years. So if you die after 10, your beneficiary gets the insurance money for the remaining 10 years. Okay. It's a smaller amount than the life annuity. So if you live past the 20 years, then the life annuity is the better choice. But if you die before the 20 years is over, then the life with 20 years certain is the better choice because someone else continues to get paid for those 20 years. Okay, so let's see what this looks like in action. Sally, who's 45 years old, is a beneficiary of her mother's $35,000 life insurance policy. Find her monthly payouts if she chooses the following. A life annuity, B, life with 20 years certain, or C, 20 years of payments. So for A, life annuity, make sure we're looking at female 45, so that's the first column, and we want life annuity, so that is options 3 and 4, and you should be seeing a $4.60 there. Again, we're going to divide by 1,000, multiply by the face value of the policy, which is $35,000. The thousands cancel, and we're left with $161. So she'd get a monthly payment of $161 for the rest of her life. If she chose B, life with 20 years certain, we're going to go 2 numbers over from the 460 and get $4.44. So again, her monthly payout would be less, but if she doesn't think she's going to make the 20 years, that's the better option because then her beneficiary will continue getting it until the 20 years is over. The last option is just getting paid out over 20 years. So there's no life annuity, it's just 20 years of payments. So that is options 1 and 2. So 20 years goes to the amount of 566. So again, we divide by 1,000, multiply by 35,000. That's $198.10. Okay. So for the life annuity, it's a lot less, but she could live another 50 years, in which case she'll end up getting a lot more than she would in C's case. Let's try another one. Mark is 55 years old. He is the beneficiary of his uncle's $60,000 life insurance policy. Find his monthly payouts if he chooses the following: A, life annuity, B, life with 10-year certain, or C, 10 years of payments. So Mark is a male, so make sure we're looking under male, 55 years. And for life annuity, we should be getting 613. So 613 times 60, because the thousands cancel, gives us $367.80. If he wants life with 10 years certain, that's just the next one over. And we should be seeing a $6. $6 times 60 is $360. 10 years of payments, that is options 1 and 2. That's a fixed number of years. So we go to 10, that's the first column, and we should be getting 9.60. Multiply by 60, and we get 576. So again, month to month, C looks like the best option, but after 10 years, he's no longer going to get paid if he's in option C. If he's still alive after 10 years, he's still going to get payments for A and B. So we're going to see what happens if he lives for, say, another 20 years. How much will Mark get from each payout if he lives for 20 more years? So in any of the cases, what we're going to do is we're going to take the monthly payout, multiply by 12, because there are 12 months in a year, and then multiply by the number of years in which he's getting that payout for. So for the first one, we're going to take the 367.80, multiply by 12, multiply by 20, because he's getting paid for the full 20 years. That'll give him $88,272. For B, we're going to take the 360, multiply by 12, multiply by 20. It's going to get $86,400. So again, the life annuity with 10 years certain is going to be less than the life annuity. For the last one, remember that it was only getting paid out over 10 years. So we're going to multiply by 10, not by 20. He's not getting paid for the 20 years. He's only getting paid for the first 10. So he's only going to get $69,120. So if you think you're going to live a lot longer, then you want the life annuity. If you don't think you're going to live that long, then either life with so many years certain or just a straight up number of years is probably the way to go. Notice that in any case, you end up getting more than what the life insurance was for. And that's really because if you think about it, Mark's uncle was putting money into what amounts to a bank. And then Mark is withdrawing it, and he's getting all that interest. So even the 10 years one, that's a lot more than the $60,000 policy. And again, you can think of it as interest. So let's try another one. Bethany, who's 60 years old, is a beneficiary of her husband's $50,000 life insurance policy. Find how long she can receive payments if she wants A, $385 per month, or B, $300 per month. So we haven't done this type yet. This is the fixed amount. So this one we kind of have to work backwards in order to get our answer. We don't have a number to look up on the table. So we're not going to be taking some number, multiplying it by the 50,000, dividing by 1,000. Instead, we're trying to look for the number in the table based on the outcome. So we're going to have a number from the table times 50 equals 385. So remember, this is really the table's number divided by 1,000 times 50,000. So I'm just canceling the thousands. Okay, so to solve for this, I'm going to take the 385, divide by 50. So the table number is $7.70. So again, this is a fixed amount, so we're looking at options 1 and 2, so the left half of our table. And the amount, we're going to look for the number in the table that's closest to 7.70. And that happens to be the 7.71. Hopefully you can find it. And then our answer is the year associated with that amount, which is 14. Okay, so if she wants $385 per month, she'll get it for about 14 years. What about B? What if she wants $300 per month? So again, we're going to have the table times the 50 equals, that should be 300, not 30. 300 divided by 50 is 6. So again, we look at the table under options 1 and 2, amount, which one is closest to 6? And that's going to be the 608. Hopefully everyone can see it. And then we just move to the column before that and look for the years, which is 18. Okay, so you kind of have to go backwards when you're looking for how long can they have it. So I want you to play around with this. Again, make sure that you understand which table to be looking at and what each table represents. So try some of the practice and let me know if you have any questions. Thanks.